Silver just crossed one of the most psychologically powerful levels in modern market history, $100 an ounce, a number that, for decades, sounded absurd, extreme, even impossible, is now printed on screens around the world. And yet, here we are. Last week, we warned that silver's momentum was beginning to slow, that the rally was starting to show early signs of exhaustion. At the time, that warning was reasonable, logical, even responsible, but markets don't reward logic in real time. They punish timing. Because being early in a market like this can be just as painful, sometimes more painful, than being outright wrong. And once again, the market has delivered one of its favorite lessons. Momentum doesn't care about your models. Let's start with the numbers, because they matter. Silver is now up 44% just this month. Zoom out a little further, and prices are up more than 180% since the breakout rally began in the second half of last year. That is not a normal move. That is not a healthy move. That is a parabolic move. And parabolic moves do not behave the way textbooks say they should. They stretch, they distort, they humiliate short sellers, and they destroy over-leveraged traders who think they're smarter than the tape. Just a few days ago, silver looked tired. Momentum indicators were rolling over. Volatility was spiking. The market looked like it needed to breathe. And then, it didn't. Instead, silver pushed higher, then higher again, then straight through $100. Meanwhile, gold, the larger, slower, more deliberate cousin, is hovering just below $5,000 an ounce, less than $20 away. In this environment, that's not a big gap. That's one headline, one tweet, one policy shock. Gold could hit $5,000 before your morning coffee cools. Now here's where it gets interesting. This rally feels emotional. It feels chaotic. It feels irrational. And yes, by many traditional measures, it is. But here's the part that making even seasoned analysts uncomfortable. Some of this move actually makes sense. Not comfortable sense, not reassuring sense, but macro sense. The latest surge in precious metals didn't come out of nowhere. Momentum reignited at the start of the week, after President Donald Trump issued threats toward European nations that refused to support his renewed bid to annex Greenland. Yes, Greenland. Not only did Trump threaten tariffs, he openly refused to rule out the use of military force, and markets heard exactly what they needed to hear: uncertainty, instability, escalation. Even when Trump later walked back the military rhetoric. In classic Trump always chickens out fashion, the damage was already done. Markets don't wait for apologies. They price in risk the moment it appears. Because here's the truth. It's not the follow-through that matters. It's the signal. And the signal was loud and clear. The idea that global borders, alliances, and trade relationships are once again negotiable or enforceable through pressure, tariffs, and force is profoundly bullish for hard assets. Gold thrives on uncertainty. Silver thrives on chaos. Over the past week, something else quietly accelerated. The so-called Sell America trade. Reports began circulating that European institutions were offloading U.S. treasuries. Not dramatically, not all at once, but steadily. And in markets, steady matters more than dramatic. Because it suggests loss of confidence, not panic. And that's far more dangerous. When capital begins to question U.S. fiscal discipline, when deficits expand without restraint, when debt issuance feels endless, the response isn't always a crash. Sometimes it's rotation. Out of bonds, out of paper promises, into hard assets that don't require trust. That debasement trade is now providing real, structural support for gold and silver, even at prices that would have seemed ridiculous just a year ago. This is why some analysts are no longer laughing at upside targets. Gold at $5,000, silver at $150. Those numbers are no longer fringe ideas whispered in dark corners of the internet. They're being spoken, cautiously, reluctantly, by mainstream strategists. Not because they want them, but because the math is forcing them there. Still, and this matters, momentum cuts both ways. Silver is not gold. Silver is thinner, less liquid, more volatile. It doesn't glide higher, it lurches. And when sentiment turns, silver doesn't drift down, it falls. 10% moves in a single day are not hypothetical anymore. They're normal. And that kind of volatility is not for the faint of heart, or the weak of stomach, or anyone trading on margin without a plan. This is where discipline matters. Because at these levels, chasing price is how portfolios get wrecked. Every parabolic market feels like it will never end, right up until the moment it pauses. And pauses feel like crashes when you buy the top. Now, does this mean the bull market is over? No, it means we are in the dangerous phase. The phase where euphoria and fear exist at the same time. The phase where upside still exists, but mistakes become expensive. History tells us something important here. The cure for high prices has always been higher prices. At some point, silver's industrial demand will respond. Manufacturers will hesitate. Substitution will be explored. Consumption growth will slow. That doesn't kill the bull market, but it creates air pockets, and air pockets are where discipline gets rewarded. So here's where we pause. Silver at $100 is historic. Gold knocking on $5,000 is extraordinary. But this is not the moment to abandon strategy for emotion, because corrections are coming. Not because the story is broken, but because markets breathe. And when they do, opportunity appears. In part 2, we're going to talk about why corrections are likely to be shallow, not catastrophic. How to think about pullbacks without panicking. Where patience beats prediction. And how investors can survive, and even thrive, in a market where momentum is king, but discipline is survival. Now let's talk about the part most people avoid when markets go vertical. The part after the celebration. The part after the headlines. The part where money is either protected or surrendered. Because while momentum is king, risk management is survival. And right now, silver is no longer a value trade. It's a momentum trade, and those obey very different rules. First, let's clear something up. A correction does not mean the bull market is over. In fact, the strongest bull markets require corrections to stay alive. Corrections reset sentiment. They shake out leverage. They punish emotional positioning. And most importantly, they create the next launch pad. The danger isn't the correction itself. The danger is being unprepared for it. At $100 silver, psychology becomes extreme. Every pullback feels like the top. Every bounce feels like the next leg to the moon. That emotional whiplash is how people give back gains they waited years to earn. So let's slow this down. Historically, when silver enters a parabolic phase, corrections tend to be fast, violent, shallow relative to the move. That means you might see a 10% or even 15% drop. Not over weeks, but over hours or days. That kind of move feels catastrophic in the moment. But zoom out, and it often barely dents the uptrend. The problem? Most people don't zoom out when red candles hit. This is why chasing price at these levels is dangerous. When silver is calm, buying strength works. When silver is parabolic, buying strength means buying other people's profits. That doesn't mean don't buy silver. It means wait for the market to come to you. Here's what patience looks like in this environment. Not prediction, not calling tops, not bragging on social media. Patience means accepting that. You will not catch the exact high. You will not catch the exact low, and you don't need to. You need good entries, not perfect ones. If silver pulls back from $100 to $92, that's not a crash. If it drops to $88, that's not failure. If it even spikes down toward the low 80s in a liquidity flush, that's the market testing conviction. And historically, those moments, not the euphoric headlines, are where long-term positions are built. Now let's talk about leverage, because this is where most people lose. Silver can move 10% in a day without warning. If you're leveraged, futures, options, margin, volatility doesn't just hurt, it kills. You can be right on direction and still be wiped out on timing. That's why professional traders repeat this phrase endlessly. Survive first, profit second. If you can't survive a 10% move against you, you shouldn't be in the trade. This is also why physical holders tend to sleep better. Physical silver doesn't care about intraday volatility. It doesn't issue margin calls. It doesn't force emotional decisions. That doesn't make it superior. It makes it different. Different tools for different strategies. Now, let's address the elephant in the room. Can silver really go higher from here? Yes, but not in a straight line. Momentum markets don't end with exhaustion. They end with indifference. When headlines stop shocking people, and when price gains stop exciting anyone, and when everyone who wants in is already in, that's when cycles end. We are not there yet.